What are the trades now ahead of that housing data and the Federal Reserve meeting? To our floor show traders, they are our stars, Teddy Weisberg and Dutch Masters. Dutch, you're agnostic. You'll go long, you'll go short. What are your trades right now?
So we are kind of running a big long short here, actually. We are long what I call the 3 C's. We've got CPRX, CCRN, and Caribou. So we're long biotech and healthcare against a big short of Whirlpool. So that's what we've got on. The inflation print yesterday, I have to tell you, just proves that raising interest rates doesn't stop the inflation on food and really in food and energy. We thought we were caught by surprise a little bit by how hot it was. Obviously, the market was really caught by surprise. And it's all about food and energy.
Yeah. OK, can I just drill down a little bit on Whirlpool? Because, again, David Kudla on Friday was saying short real estate. We obviously saw 30-year fixed rates jump above 6%. And to me, when you see that, you know that, yes, the housing market, which was already correcting. Home Depot, did you guys see Home Depot yesterday? Home Depot yesterday was falling about 6.7%. I mean, 6.5%, and it's down again today. Can you just articulate why you feel Whirlpool is the short at the moment?
Yeah, so what happened was during the pandemic, everybody bought appliances and stuff for the house and upgraded. So a lot of their 2022 and 2023 sales were pulled into 2020 and 2021. You know, the largest appliance manufacturer on the planet is Electrolux, and they have come out and said that their world really sucks right now. And I don't think Whirlpool is going to come out on October 20th with their earnings and say anything different. In fact, I think their last print was their sales were off 4.5% last quarter. I think we're going to see sales off 10 or 12%. It's going to be a disaster. We think this stock goes to 110, maybe 100. It's a long way down from there. It's already off of its high. But, you know, we're kind of weird, Liz. We actually get on the ground. We get on our Harleys. We go out to Lowe's. We go out to Home Depot. We talk to the salespeople. And our personal experience is we ordered Whirlpool products. And we were told we would get delivered in 10 days. And then we got a text in about 9 days that said, maybe November.
Oh. That is bottoms-up research, right there on the ground. Teddy, let's widen this discussion to the markets here. We're not seeing any kind of bounce after yesterday's rout. What's at the heart here? Is that how badly damaged yesterday, the effect that it had on investor sentiment?
Well, yesterday clearly was a very ugly day, Liz, but it basically underscored what's been the issue for weeks going on months. And those folks that choose to fight the Fed clearly are fighting at their own risk. I mean, interest rates are the problem. Inflation is still the problem. This isn't going to go away anytime soon. Yeah, we get relief rallies, and we had a good month in July, which was nice. But other than the first 2 weeks of the year and the month of July and perhaps 2 weeks in August, this has not been a fun year. And the reason is the Fed simply is in a restrictive, not in an accommodative mode. We're all spoiled. We went through periods of zero interest rates after 08 and 09 for almost 4 or 5 years. We went through it again during the pandemic. That, in my opinion, is a complete aberration. Perhaps we'll never see that again. I mean, my lifetime isn't clearly as long as a lot of your viewers, but certainly in my lifetime, I don't expect to see that again. And if we do, we're probably in bigger trouble than we think we're in. I just think it's a matter of the Fed is being in a restrictive mode. Interest rates are going higher. We can argue about how high they're going or where they're going. But as long as this is the background, it's a negative background for equities. I mean, there are things I guess you can do, but the best trade we have had since late March, and I've said it over and over again, has been the 3 months Treasury.
Sure.
I mean, you can get 3% on your money, 3 months, virtually risk-free, 60 bips, maybe 70 bips better than money market funds. to me, it's a layup. I mean, I can't believe everybody's not doing it.
Yeah, right now we're looking at a yield of about 3.14 for the 3-month, 10-year 3.42. And by the way, Teddy, I'll go long cryogenics because I want you to last forever, my friend. Dutch, Tech got slaughtered yesterday. Obviously, some of the biggest names got a lot cheaper. Apple, Meta's still down today, but we are seeing a little bit of retracement, certainly to the upside for Microsoft, some of these other names. But how do you feel about tech? I know in the past, when it was a really smart trade, you were shorting NASDAQ 100. What are you doing now?
We're completely away from tech entirely. The last thing we bought was about a few minutes ago. We just bought a whole bunch of eggs. CALM. It's all about eggs, man. It's about food. It's about energy.
Calman.
You know, you can't bake a cake without eggs, right? So come on.
Well, pasta. Can't make pasta without eggs, right?
I went and had a fantastic pasta dinner at Matteo's last night in Las Vegas, and Matteo came and sat at our table twice. It was really wonderful.
Well, was the restaurant full? Because we're going to talk restaurants in just a minute.
I'll tell you what, jammed.
Well, that's a good sign. And therein lies the conundrum. We still have people who are spending money here, but the question becomes, if we start to see these rates jump 1% next week, when the Fed meets, there may be a little bit of a shaken and stirred market. We're all over it, you guys, and thank you for being here. Teddy, Dutch, great to see you. Anytime.